Hey everyone, it's Hunter Brustein from the Venture Analyst. Today I want to talk about what's happening in the energy market right now, because the setup of Canadian energy specifically is unlike anything I've tracked over the time of running this publication. So on February 28, 2026, the US and Israel launched a joint attack on Iran. The supreme leader was killed within 48 hours. Every major shipment company, Macerx, CMA, CGM, Hapag-Lloyd, suspend all Strait Hormuz transits. The Strait, which normally carries 20 million barrels of oil per day, went from 100 ships daily to 21 total tankers in 3 weeks. 150 ships are anchored outside of it right now. Brent crude hit $126 a barrel. At the same time, gold set an all-time high of $5,589 an ounce in January. It's pulled back to around $4,500 this week after a hawkish Fed decision, but it's still up nearly $1,500 year over year. Central banks bought 863 tons of gold in 2025 alone, third consecutive year of historically elevated buying. And Canada is sitting on the intersection of all of this. The senior fellow at the Council of Foreign Relations said it directly this week on CBC. The U.S. cannot achieve its industrial reshoring goals without Canadian resources. 1/3 of Canada's export recovery from the trade war came from oil. Canada's crude is priced in U.S. dollars and exempt from energy tariffs. I'm going to break this down: normal situation, the gold structural case, Canada's position, and then the actual names on the TSX. This is free research, not investment advice. Let's go. Let's go over the situation in plain terms, because the scale this is kind of hard to absorb from the headlines only. So in the first card, we see the U.S.-Israeli strikes on Iran. On February 28th, U.S. and Israeli forces struck Iran. The supreme leader was killed. Iran's Revolutionary Guard immediately issued a warning prohibited vessel passage through the strait. They backed it up. 21 confirmed attacks on the merchant ships since the conflict began. At least 5 tankers damaged, 2 killed, 150 ships stranded. The strait didn't close the naval blockade. Iran didn't need one. All it was drone strikes near the waterway, and every insurer in the world pulled out simultaneously. As NPR analysis put it all Iran had to do was several drone strikes in the vicinity of the Strait of Hormuz, and all of a sudden, insurers and shipping companies decided that it was unsafe. On the second card, we see the IEA confirms the scale. The IEA's March 2026 oil market report: global supply fell 8 million barrels per day in March. Gulf producers cut 8 to 10 million barrels per day. Iraq declared force majeure on its oil exports, legally suspended contractual obligation because it was physically cannot ship the oil. Brent hit $126, high since Russia's Ukraine invasion. Helmius Croft, global head of commodity strategies at RBC Capital Markets, said on NPR, "We're now facing what looks like the biggest energy crisis since the oil embargo in 1970s. That's not commentator, that's a senior strategist at a major bank. On the third card, I go over the emergency response and why it's not enough. March 11th, the IEA coordinated the release of 400 million barrels from strategic petroleum reserves. This is the largest in IEA history. Sounds enormous, but here's the math. Al Jazeera reported 400 million barrels covers roughly 20 days of normal Hormuz flow. Global consumption runs at 105 million barrels per day. The entire emergency release covers less than 4 days of the total global consumption. This is a stopgap, and this is not a solution. So take in the numbers on the screen. We have the normal daily Hormuz flow, which is 20% of the global seaborne oil. The Brent crude peak, highest since Russia-Ukraine 2022. We have Brent at the time of filming. We have the 21 tankers, which is the total transit since February 28th. I get 100 plus per day before. We have the 415 BBL. The US SPR as of February 18 covers 20 days of Hormuz flows. The point here is that even if OPEC Plus increases output and they've pledged 206,000 barrels per day, a significant portion of Gulf spare capacity cannot reach global markets. If Hormuz stays closed, Saudi's east-west pipeline and the UAE's Fujairah route helps on margins. They don't offset the full closure, but the disruption is structural until the strait reopens. So let me talk about gold. There's a lot of noise around this week specifically, and I want to separate the structural case from the short-term movement. So the price context here is gold set an all-time high at 5,589 per ounce in January 2026. The World Gold Council confirmed 53 new all-time highs for gold in 2025 alone. The full year average price was $3,431, up 44% year over year. Gold is up over 60% in 2025. 1 year ago, March 2025, gold was approximately $3,044 per ounce. Fortune confirmed on March 19 that gold was at $4,551, representing a $1,507 gain year over year. That is a 49% move in 12 months. This week's gold price dropped about 9%. This is the worst weekly performance in years. USA Gold's analysis explains why this specifically. The Fed held at 3.5 to 3.75% on March 19th. This hawkish signal. SP Angels Metals analyst Arthur Pierce described it as the tourist money leaving in the space. Generalists and momentum funds that chased gold's 66% surge in 2025 are now exiting. The structural central bank bid, the driver that actually matters, has not been reversed. Let's go over the drivers. So first we have the central bank buying. World Gold Council confirmed the central banks bought 863 tons in 2025. Before that, 3 consecutive years of above 1,000 tons, the highest sustained buying since the gold standard era. That 2024 figure was 1,045 tons. JP Morgan projects 755 tons of central bank purchases in 2026. That's lower than 1,000 plus ton peak years. But here's the mechanical reason JP Morgan gave. At 4,000 to 5,000 per ounce, central banks don't need that many tons to move their gold allocation percentage. The intent hasn't changed. The math of the higher prices means fewer tons purchased to achieve the same reserve allocation. In 2026, World Gold Council data shows a demand broadening. Uzbekistan continued to buy its buying streak. Malaysia buy gold for the first time since 2018, and Korea planning gold ETF investment for the first time since 2013. It's not 3 countries driving this, it's spreading across the world. The second driver we have is the dollar weaponization. This is a real structural shift. This is the least coverage but matters most long term. When Western nations froze Russia's assets in 2022, every sovereign balance sheet outside the Western alliance drew the same conclusion. Dollar-denominated reserves can be confiscated. Physical gold cannot. State Street's March 2026 gold monitor confirmed the scale of this. The US dollar share of global FX reserves has fallen to its lowest level since 1994, approximately 40%, while gold share has risen to its highest since 1991. Approximately 30% USD gold reserves, down roughly 12% year over year. Gold reserves up 40% year over year. This is structural allocation and not a tactical trade. So the third driver would be the Hormuz stagflation setup. So as oil supply shock the magnitude, this drives inflation. The Fed cannot raise rates aggressively to fight it because growth is already under pressure. In February 2026, we saw that 92,000 US jobs were lost. Unemployment is also 4.4%. Manufacturing contracting in 23 of the last 25 months. That combination of inflation rising, central banks constrained, is a textbook stagflation setup. Stagflation is historically gold's best environment, and in the 1970s, energy crisis drove gold from 35 to over 800 per ounce over the decade. The fourth driver would be the Fed constraint. The Fed holding it at 3.5 to 3.75% interest rates this week, and it caused the gold sell-off. But at the same time, energy prices surged, driving gold, which is driving inflation that the Fed cannot fully combat without breaking already a softening economy. That policy paralysis, unable to raise rates aggressively, unable to cut rates, keeps real yields low and removes gold's opportunity cost. The structural support remains. Now here's the part of the thesis I think most Canadian investors actually haven't fully processed, and let me be direct here. So we have a few pillars. So pillar 1 is oil, tariff exempt and USD revenue. Canadian crude is priced in US dollars. It is exempt from energy tariffs. When Brent goes to $67 to $126 in a month, Canadian producers capture the entire gain with no tariff friction. CBC News reported this week that approximately 1/3 of Canada's export recovery was from trade war losses came from oil exports alone. The U.S. imports a significant amount of Canada's approximate 5.5 million barrel per day production. Midwest refineries specifically configured to Canadian heavy crude. That configuration cannot be changed quickly, and this is not leverage Canada invented. It is a physical reality of North American refining infrastructure. The second pillar we have is critical minerals. This is reshoring dependency. The U.S. reshoring strategy requires North American mineral supply chains. Semiconductors, EV, battery, defense manufacturing, data centers all depend on specific critical minerals that Canada produces at a scale. The Wikipedia article on the Hormuz crisis specifically noted that the U.S. defense industry faces near total disruption of critical minerals normally flowing through the strait. Canada's mineral endowment is not a negotiation chip, it's a geographic fact. The third pillar we have is the LNG, direct Hormuz beneficiary. 1/5 of the world's LNG normally transits the Strait of Hormuz. Qatar Energy invoked force majeure on all LNG shipments in early March when the crisis escalated. Europe gets 12 to 14% of the LNG from Qatar through the strait. Canada has LNG export capacity in the development. The Hormuz disruption has turned Canadian LNG from a long-term strategic opportunity into near-term urgency that Canadian energy developers have not faced before. Now let me explain the oil-seismic-gold complex as the connected thesis. It's not just buy gold, buy oil. There's a specific sequence that repeats every cycle. So in the first row, we have the oil chain. Oil prices at 90 to 126 per barrel mean producers generating record cash flows. When producers have cash flow and macro supportive, they expand capital budgets. Seismic is always first. Before you drill a well, you need to understand the geology underneath. Seismic companies provide that data. They pick up the drill bit, then producers re-rate as the drill programs confirm reserves and junior producers to become acquisition targets. This sequence is consistent across all energy upcycle. On row 2, we have the gold chain. Gold at 4,500 to 5,589 means miners are operating super margins. Their models are never calibrated to handle. The cash flow goes into exploration spending, and more exploration means more seismic demand for mining on top of the oil and gas demand. Both cycles running simultaneously, royalty companies capture 100% of the price upside with zero operating cost inflation. As gold rises, their margins expand automatically, and that is the cleanest position in commodity bull run. When oil and gold are elevated simultaneously, which is rare, the entire framework activates at once. That is the current environment. The goal is to understand which part of the framework you're getting exposure with each name you own. Let's go over some companies. This is not a buy recommendation. These are names worth researching. Everyone requires individual due diligence on valuation, balance sheet, and your own risk tolerance. This is a framework, not a shopping list. So we have the bucket 1, oil sands, low break even. We have CNQ, Canadian Natural Resources, 25 consecutive dividend growth streak. One of the lowest break-even costs in the oil sand, and 90 to 126 oil. They're generating maximum cash flow. The balance sheet is strong. We have CV.TO, Senvis Energy, higher beta to oil price than CNQ. U.S. refining assets from the Husky acquisition provided downstream kicker when refined products spread widely. And Suncor, SCU.TO, also SCU on the American market, integrated. This is the refining and downstream business creates a partial buffer if oil pulls back, the most defensive of all three in the Hormuz resolution scenario. In the second bucket, we have the royalties, the zero drilling risk. We have Topaz Energy, TPZ.TO, approximately 95% of free cash flow margin, royalty portfolio tied heavily to Tourmaline, Canada's largest natural resource producer, has 100% price upside, zero operating cost. Then we have Freehold Royalties, FRU.TO. They collect royalties from over 100 operators across Western Canada and U.S. monthly dividends. There's zero drilling costs, zero new well capital required. We have Franco-Nevada, FNV.TO, the gold royalty and streaming giant at 4,500 to 5,500 gold. Every dollar increase drops almost directly at the bottom line. There's no mining operational risk. At the third bucket, we have the gold producing streamers. We have the Bear Gold, ABX.TO, probably the biggest one. They have record cash flows at the current gold prices, globally diversified, one of the 2 or 3 largest gold miners on earth. We have Agnico Eagle, AEM.TO. In my view, I think this is the highest quality gold miner at the TSX by operational track record. Canadian focus, clean balance sheet, decades of execution. Then we also have Wheaton Precious Metal, WPM.TO, as their streaming model. They provide capital to miners for the right to buy gold at below market prices, zero mining operational risk, and dividend growing. And let me not skip the risk. Every one of these is real and worth understanding before you act on anything in this video. First risk wave is the Hormuz reopening quickly. France, Germany, and the UK announced on March 19 they're ready to participate in the reopening efforts. Iraq is negotiating with Iran on safe passage, and the US has been allowing Iranian tankers through. If the strait opens in weeks, oil falls hard and fast. The $40 per barrel geopolitical premium comes out quickly. Notice before sizing any positions. We also have the second risk of gold weekly sell-off. This week is the precedent. Gold has just posted the worst weekly performance in years, down approximately 9% in 1 week. USA gold is clear. This is tourist money exiting, not the structural beta reversing, but do not confuse structural bull thesis with the absence of near-term volatility. These two can coexist. Third risk, we have the OPEC Plus supply response. OPEC Plus pledged 206,000 barrels per day increase. Russia and Kazakhstan are increasing output. Saudi Arabia has been increasing loading, and the supply response is partially working. It's part of why oil is $92 to $103 and not $126. A larger coordinated response normalizes prices faster than expected. We also have demand destruction, which is the fourth risk. Dallas Federal Reserve, a 3-quarter Hormuz closure scenario cuts global GDP by 1.3% points. A recession-level demand destruction is the oil bear case. Supply constrained, but demand falls faster. February 2026 already showed 92,000 U.S. jobs losses. If the economy breaks under inflation pressure, oil demands fall. Fifth risk, we have the Canadian dollar. TSX listed companies are in the CAD. A significant CAD USD move affects USD based investors' returns. Accounts for currency in your position sizing is relevant if this is your situation. A sixth risk we have is trade resolution. A Canada-US trade agreement removes the strategic leverage premium baked into Canadian energy names right now. A net positive for Canadian broadly, but mixed for the specific thesis. The oil and gold fundamentals remain, but the urgency premium compresses. So let me close this out. This is not a regular macro environment. RBC Capital Markets called the biggest energy crisis since the 1970s oil embargo. The IEA released the largest Mercy Reserve stockpile in history, and gold set 53 all-time highs in a single calendar year. Central banks are structurally reallocating reserves away from the US dollar to the fastest pace in 3 decades, and Canada sits at the center of it. Oil exempt from tariffs, critical minerals to reshoring strategy requires, LNG export capacity that went long-term strategic to near-term urgent overnight. Oil confirmed global supply fell 8 MBD in March. Brent peaked 126. Canadian producers are low break even. USD revenue tariff exempt beneficiaries. This environment that oil sands were designed for. Gold, all-time high 5,589. We went over this in January. Currently at around 4,500. After the Fed-driven pullback, still up about 1,500 year over year. 863 tons of the central bank buying in 2025. The structural bid is real. This week's sell-off is tourist money exiting, not the central bank bid reversing. Seismic. When oil and gold exploration budgets both expand simultaneously, seismic is the first call. Data before the drill. Data for drill. These names move ahead of producers. Watch them as leading indicator. How to position yourself. Own quality royalties. Zero drill risk, 100% price upside. Own quality producers, low break even, USD revenue. Size for volatility. This environment moves fast and the risks are real. The thesis is intact. Both things are true at once. The presentation for this video is on my Substack, link in the description. If you want to go deeper into my work, initiation reports, full valuation models, the premium watch list, that's in the paid tier. I'm Yonton, this is the Venture Analyst, and I'll see you in the next one.